Carl, talk to me about this 1-2 punch. What does it mean in terms of further pain from your perspective?
Well, certainly. Thanks for having me on today. I agree with the previous guest that the Fed certainly isn't done yet. The 1-2 punch being that seems like 2023 estimates for earnings may still be too high and interest rates are not. Just kind of encompassing what the previous guest had said, what many are missing is that even if inflation has peaked, that doesn't mean interest rates decline soon. If we think about the Fed's long-term inflation target, even after inflation subsides, of close to 2%, if you add on the 1 to 2% real yield premium that usually is commanded by investors without Fed intervention, that gets you closer to 3 or 4 anyway. So the most important takeaway on interest rates is that a pause in rate hikes does not mean a cut. If we look back to how this affects earnings estimates, we've already mentioned kind of in the previous weeks how a stronger dollar has been a headwind, and inflation is making cost, including labor, more expensive. Falling profits can certainly weigh on the labor market and unemployment through layoffs, but it's encouraging that we haven't seen much of that yet, and the labor market is strong.
So does the equity market continue to take its cue from the bond market here?
I think they're kind of trading a little bit hand in hand if you kind of get the thought that investors are looking to what interest rate to sort of discount future cash flows. And you're going to have to look past the bumpiness of earnings reports and falling future estimates in order for the overall index to move a little higher. It's probably going to be sometime next year before there's a confidence that rates have peaked, and multiples are unlikely to expand before those estimates have bottomed. That being said, it should be a good time for stock pickers to add relative value.
It's been a hard year. I've lost money in stocks. I've lost money in bonds. I've lost money everywhere. How can I make a little money over the next year, Carl? Where?
No, sure, you're not alone. I think prospectively, one thing that is good is that if you look back, a lot of savers have previously been punished, in terms of what they could earn from the fixed income markets, which was below inflation. Now that inflation has pushed up interest rates, you can even get 1 to 2 year short-term bond investments that are at least starting to earn an absolute return that's better than the 0 to 1% you could have received 12 months ago. There are some stocks we like out there, however. Some of them which I'm happy to discuss.
Yeah, name them quick, and then we'll come back and pick up on them.
Sure, absolutely. So we like West Pharmaceutical Services, which is a dominant player in packaging and delivery components for injectable therapeutics. We actually still like Copart, which is an online vehicle auction platform and remarketing services, connects buyers and sellers. There's a strong network effect. And if you can stomach it, we also like the artist formerly known as Facebook, Meta.
It's like Kanye. It's Ye. Now it's Meta. I want to turn to Morgan now, who wants to bring us up to date on the markets.
Yeah, so before we dig into those a little bit further, Carl, I mean, just to take a moment here, we are at session highs with all the major averages on this Friday afternoon, which makes it notable given the fact that the last several Fridays haven't been so strong. We've got all the major averages up more than 2% right now. The Dow is up 665 points. The S&P is up 76 points, 3742. The NASDAQ is up 2% as well. Every sector in the green in the S&P right now. It is options expiration today, too. Carl, to go back to Meta, as we do look to another week of earnings, why? Why do you like this name? Is it because it's so beaten down?
Well, it's certainly one reason that makes it more attractive, I think, than certainly it was at the beginning of the year. It's already dropped 60%. While there is competition, they still possess one of the most widely used social applications in the world. The addressable audience is still expanding, although certainly slower than it used to. And although you saw some weakness certainly today from the Snap-related news, if you read through their press release, you noted that the quarter was still tracking with a positive 9% growth, though they were budgeting 0% internally. The transition from traditional marketing to digital is not over. And you're right, the valuation is kind of simply too cheap to ignore if you're looking at 12 times earnings estimates for Meta for next year, which is offering a below-market multiple and above-average growth.
Shepard Smith here. Thanks for watching CNBC on YouTube.